Are you ready for market turbulence? Our experts dive into the disconnect between high earnings expectations and a slowing economy. With surprising inflation data and potential Fed rate cuts on the horizon, this is the critical moment to stay informed. Discover the risks and opportunities that lie ahead and protect your investments from the unexpected. Today on Financial News in Review, we will summarize the following videos. From Adam Taggart, Thoughtful Money, we have stocks remain overbought. Will poor earnings end the rally? Lance Roberts and Adam Taggart. From Blockworks Macro, we have What's the End Game for Inflation? Weekly Roundup. From David Lynn, we have Is Economy Plunging into Great Depression 2.0? George Selgin. Welcome back to Thoughtful Money. I'm your host, Adam Taggart, bringing you in-depth insights to navigate the complex world of markets and finance. Joining me today is the ever-insightful Lance Roberts, Chief Investment Strategist at RIA Advisors and creator of the Simplivisor platform. Today, we discuss the state of the stock market, inflation data, and the Federal Reserve's latest moves. With Lance's expertise, we aim to uncover the forces driving the current market trends and what investors should anticipate going forward. In this video, Lance Roberts and Adam Taggart analyze whether the current rally in stocks can sustain itself amid poor earnings reports. Roberts argues that there is a significant disconnect between elevated earnings expectations set by Wall Street analysts and the reality of an economy growing at a modest rate of 1.5% to 2%. This discrepancy could pose risks to the market as companies begin to announce their earnings and provide guidance. Here are the key points discussed by Lance Roberts. Topic: Earnings season risk. Wall Street analysts have set high earnings growth estimates of about 20% annually for the coming year. Roberts notes a disconnect between these earnings estimations and an economy that's only growing at 1.5% to 2%, suggesting that actual earnings may disappoint investors. Topic: Federal Reserve and inflation. Recent cooler-than-expected CPI and PPI data have pointed towards potential disinflation, aligning with Jerome Powell's commentary on an unstable but evolving economic outlook. Despite this, the Fed's dot plot suggests future rate cuts may be delayed into next year. Topic: Market dynamics. Markets reacted positively to the Fed's latest guidance, although nothing substantially changed except minor adjustments to the dot plot. There is an emerging awareness of economic slowdown, reflected in declining yields and increasing bond prices. Topic: Global influences. Political uncertainty in France and other global events are influencing bond markets, causing a flight to safety into U.S. Treasuries. Such global dynamics add a layer of complexity that could affect market stability. Topic: Portfolio management. Roberts emphasizes the importance of understanding market breadth and institutional buying dynamics. Simplivisor platform offers tools to monitor these aspects and make informed decisions. Lance Roberts made the following predictions. Prediction: Earnings disappointment. Roberts anticipates a potential disappointment in upcoming earnings seasons as actual earnings may not meet the elevated expectations, which could lead to market corrections. Prediction: Continued economic slowdown. Roberts suggests that ongoing data points towards an economic slowdown, which may bring forward discussions about rate cuts by the Fed. Prediction: Market volatility. Given the disconnect between earnings expectations and economic realities, a high chance of increased market volatility is predicted. Lance Roberts wraps up by urging caution during this earnings season, advising investors to keep a close eye on earnings reports and guidance from companies. There's a significant risk of overbought conditions correcting themselves due to the economic slowdown and misaligned earnings expectations. He underscores the necessity of data-driven decision-making and offers Simplivisor as a comprehensive tool for investors to better navigate these uncertain times. Lastly, staying informed and adaptable is crucial in this dynamic market environment. Welcome back to another explosive episode of Blockworks Macros on the Margin. Today, we're diving deep into the jaw-dropping implications of the latest Federal Open Market Committee (FOMC) meeting and its impact on inflation, interest rates, and market dynamics. Our guests, Quinn and Tyler, are seasoned in macroeconomic analysis and financial markets, with Quinn holding a particularly keen eye on market structures and Tyler's expertise on bond markets and liquidity cycles. Let's see if there are any biases at play. Quinn historically has been cautious on inflation projections, whereas Tyler often provides a contrarian view regarding economic policies. Today's discussion revolves around the end game for inflation, specifically analyzing the latest moves by the Federal Reserve and what these mean for the broader economy. The guests argue whether the Fed is preparing for more rate cuts or if they're positioning themselves to tackle lingering inflation head on, while also examining the impacts of these decisions on market stability and asset prices. They delve into sector specific impacts, dissect bond market reactions, and discuss how the overarching fiscal and monetary policies may potentially drive market movements in the near future. Here are the key points discussed by Quinn and Tyler. Topic: Federal Reserve's latest moves. The FOMC meeting surprised many by forecasting only one rate cut for 2024 compared to the previous three cuts forecasted. Discussion over whether the updated dot plot was prepared before or after the recent CPI print, which came in lower than expected. Topic: Market reactions. Despite the hawkish tone, the market's initial reaction was muted. This contrasted the soft CPI data earlier that day. The bond market indicates disinflation or concern over persistent inflation, shown through rising real rates and changing yield spreads. Topic: Sector-specific impacts. High-yield credit spreads have shown some stress, indicating potential risk in corporate bonds. Rising high-yield spreads could complicate the equity market stability, particularly affecting small caps and certain sectors. Topic: Household inflation and shelter costs. Deeper analysis reveals that used car prices and motor vehicle insurance are driving down recent inflation metrics. Owners' equivalent rent and shelter costs, which are lagging indicators, remain stubbornly high, making it difficult to hit the Fed's 2% inflation target. Quinn and Tyler made the following predictions. Prediction: Fed's hawkish stand likely to continue. Despite market hopes for dovish policies, the Fed seems poised for more hawkish measures based on recent member statements. Further market corrections anticipated as a result of the Fed's stance on inflation and monetary policy. Prediction: Potential financial market volatility. Predictions for increased volatility, especially within tech stocks, as they currently dominate market flows. A likely tightening in the financial markets, warned via high-yield credit spreads and potential euro and yen dynamics impacting the US dollar. Ultimately, the episode emphasizes the delicate balancing act the Fed is performing between curbing inflation and avoiding economic downturns. Quinn and Tyler both foresee a challenging path ahead, with increased market volatility and potential for policy mistakes. Their call to action for viewers is to stay informed, pay attention to evolving data, and be prepared for both near-term pains and long-term opportunities. Welcome back to the David Lynn Report. Today's fascinating discussion is with the renowned George Selgin, a senior fellow at the Cato Institute, professor emeritus of economics at the University of Georgia, and acclaimed author. Today, George and David will delve into the historical and modern economic parallels, especially focusing on whether our current economic climate could spiral into another Great Depression. George Selgin's core thesis in this discussion revolves around debunking misconceptions about the role of the New Deal in ending the Great Depression. Selgin argues that it was not the New Deal, nor World War II alone, that drove the U.S. out of the Great Depression, but a mix of shifts in government-business relations and increased private investment spurred by more stable and less interventionist policies post-War II. He extends this thesis to argue about the relative resilience of the current economy against dramatic downturns, unlike what was experienced in the 1930s. Here are the key points discussed by George Selgin. Topic: Government policies and economic recovery. The U.S. didn't truly exit the Great Depression until after World War II, despite temporary economic booms during the war. Pre-World War II, the New Deal had minimal fiscal and monetary stimulus compared to modern standards. Post-World War II recovery was driven more by private investment and less hostile government policies towards businesses. Topic: Role of the New Deal. Many New Deal policies did harm, while some beneficial programs focused on debt relief. There was significant monetary stimulus post-1934 due to gold inflows, independent of Federal Reserve actions. Topic: Effect of WO2 on economic recovery. War temporarily increased demand and production, resolving unemployment due to the draft. True recovery was about avoiding a relapse into depression post-war through positive shifts in private investments. Topic: Private investment and government relations. Government's cooperation with businesses during World War II created lasting trust, boosting private investments. Stable banking post 1933 helped set the stage for economic recovery. Topic: Modern economic resilience. Today's economy is more diverse and globally interconnected, adding layers of resilience. Despite concerns, high government spending provides a countercyclical buffer to economic downturns. Topic: Bitcoin and alternative investments. Bitcoin is more an investment asset than a currency, useful for hedging against inflation and protecting wealth from government intervention. Gold and Bitcoin have distinct advantages and may both have a role in a diversified portfolio. George Selgin made the following predictions. Prediction: Global political instability and economic policies. Selgin worries about the current political polarization and its impact on economic policies, but doesn't foresee an imminent economic collapse akin to the 1930s. Prediction: Technological impact on labor market. AI and automation will replace workers when economically sensible, affecting high-wage regions first. George Selgin concludes that while historical comparisons offer valuable lessons, the modern economy is less likely to see a crisis as severe as the Great Depression due to its diversified nature and different fiscal policies. He emphasizes that sound government-business relations and stable investment climates are crucial for economic resilience. For personal financial security, he advises looking at diverse investments, including cryptocurrencies and gold, to hedge against economic uncertainties. Stay informed, stay invested, and continue to explore intelligent solutions for economic security. In these videos, experts consistently highlight the worrying disconnect between market expectations and economic realities, suggesting increased volatility ahead. Disagreements persist around the Federal Reserve's policy direction and inflation's future trajectory. However, there's unanimous advice on staying data-driven and adaptable. Whether you're eyeing earnings reports or policy shifts, these insights emphasize the importance of being prepared for both risks and rewards in the current economic landscape. Thanks for watching Financial News in Review for Saturday, June 15th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see, drop a comment below. See you next time.